So let's go ahead and begin. I have a couple of announcements to make. Well, really actually one major announcement and then, well, two announcements. So for those of you that know and have been to this class before, I always welcome questions. I generally start off the process talking about a particular aspect of trading outside of the strategy aspect, outside of the reading chart, outside, things that are pitfalls that you come up with, aspects of the mental game, things that I've gone through, through my now over a decade career. And so, I've experienced a lot of the mental game of this, and it's been a very strong part of my process. And so I'll be sharing some things with that. That's usually the first 5-10 minutes, and then we get into reading charts, particularly looking at a trade that I took just recently. Some of the traders in my course on the forum, they also got in as well. So congrats to them who got into this one. It worked out really, really nicely. And so we're going to go over that, what I was seeing from a price action perspective, how I place my stop, limit, entry, exit, the whole thing. So really just kind of unfolding and unpacking the process so you can see that. So that's what we're going to be covering today. And if we have some time, we're going to be looking at the current environment on a few instruments and where I see things are going and what kind of moves I'm watching or looking at. Now, in terms of the announcement, so this will be the last webinar for a little bit, maybe a month, maybe a little bit longer. I'm going to be traveling for all of July in the States, visiting family, visiting friends, visiting my girlfriend. My parents are getting old. They're kind of getting up there in age. And so I'm going to be spending some time with them. Even though, I can fly them out here, it's just much harder for them, at their age to fly long distances. A direct flight is almost 17 hours. So, even though I even offered to fly in business class out here. So I said, hey, I'll send you out business class, no big deal. But it's just a long flight for them physically. And so more so for my dad, but they're up there in age. So with that being said, I'm going to see them, and I'm going to be spending some time with my family back home. Plus in early August, a good friend of mine is getting married, so I will be seeing him. So I'm not sure when I'll be coming back to do the next webinar. So it's going to be a little bit. So that's the main announcement. And so this will be the last one for a while. Now, in terms of today's lesson, so on the trading psychology aspect, I kind of want to get into something real briefly that I did a video on, which is trading and the mindset of abundance, trading and wealth. And so, I talked about this a little bit last week and in the trading mindset webinar that was recorded as well. But I want to talk about it on a couple aspects that I haven't quite unpacked yet. So, and this more has to do around, I think for those of you that the trading mindset, I was talking about how, I found this forum and how this one person on the forum, they had, basically bought a bunch of strategies or something like that. They would buy these strategies, like hundreds and hundreds of strategies. And then they would share them with people all over the forum. And, and they were, what they were doing with them, who knows? But I would be willing to bet that that person has the wrong mindset around trading. And I want to talk about trading, what it has to do, what the mindset has to do with wealth and abundance, and what this particular behavior tends to create in a mindset with traders that will interfere with you becoming successful as a trader. If you try and take the easy way out, which is, instead of using your own money to pay for something or something like that, you look for a forum and you look to find the free version of it or a download or whatever, or something like that. This is what it translates in your mind. This is the underlying unconscious program that will be running in your mind that will constantly interfering with you becoming a successful trader. It basically means two things. It means that, let's say you went to one of these forums and you decided to get something for free that wasn't given to you, that you didn't pay for. Whatever it was. It could have been an ebook, it could have been a CD, it could have been a movie, it could have been anything. It could have been an EA, it could have been anything. But let's relate it to trading. Let's say it was an EA. You're actually communicating to your mind two things subtly, whether you know it or not. The one thing you're communicating to your mind is that you're looking to take the easy way out. That you're looking for the silver bullet that's going to solve your problems. And you believe that silver bullet is a system. And that is a mistaken belief, but the main damage that it causes is that you're actually communicating to your mind and to your being that you're looking to take the easy way out. You're not willing to do the work. You're not willing to learn to understand a system inside and out. You're not willing to pay for it. You're not willing to use your own time and hard-earned money to pay for it and learn and study that method inside and out and really understand it. You're looking to take the easy way out. And what that translates into is in the later moments or in the developing moments of your trading, when you come up against your fears, your emotions, or the areas where maybe you're not totally disciplined, the bottom line is, in the trading process, you're going to come up against obstacles. If I had to define the trading process, it's really a process of persistence and fortitude. Kind of like, some things are heart, they require a lot of heart. To be a successful trader, it doesn't matter how intelligent you are per se. It doesn't matter your mathematical background or skills. It doesn't matter whether you had a degree in business or not. What's going to really carry you through all the difficulties is really going to be your persistence and your fortitude to go up against your mental obstacles, your uncomfortableness with leaving a position open and not knowing whether it's going to hit your stop or your target, your uncomfortableness with being fully disciplined, doing all the work that is necessary to be a professional trader, which is not just pushing buttons, loading up charts, finding trade opportunities, and pressing buttons. If it was, a lot more people would be successful. Trading encompasses a lot more than that. And it requires a lot of work, and it requires a lot of persistence and fortitude on your part. And the person that has the most persistence and the most fortitude and is willing to do the work is the one that is going to become a successful trader. And so when you take the easy way out, when those really difficult moments come, you will not have the tangible experience nor the psychological fortitude to say, I'm willing to do the work to follow my money management system. I'm willing to do the work to always follow my trading system and the trading plan. I'm willing to do the work to fill in my trade journal for every single trade, to review my trades weekly and monthly, to do the data and numbers on my performance, to make sure I'm constantly engaging in the learning process to understand my system inside and out, to not trade when I'm emotionally off or psychologically off, to not chase things when my system is not telling me to get in, even though the market is screaming. Those difficult moments, when they come, you'll take the easy way out again, because that's what you've communicated to yourself as the way forward. And that will not support you in your, it not only will not support you in your process, it will constantly undermine and pull out the framework that is what builds the foundation for a successful trader. And so, with that being said, that's one thing that it communicates. The other thing that it communicates is that you're saying, hey, I don't want to pay for this EA because it's $199 or $500 or $2,000 or whatever. You're saying that I don't want to pay for this because it's too much money for me to pay. I don't want to pay my own money for that. What you're basically communicating is that you don't have the mindset of abundance and that $500 or $2,000 is too much money. So how do you expect to be a professional trader who's constantly increasing their position size, constantly building their position size, making more money, trading big positions or bigger positions, if that amount of money is too much for you? How much of that? How can you ever get to that point if you're saying, hey, $199 is too much for me to spend, or $500 is too much for me to spend, or $2,000 is too much for me to spend? How could you ever say, I'm willing to trade big lots when you are not even willing to spend $199 on some particular thing that you want? It's a contradictory message inside your mind, and those two things cannot coexist. They cannot coexist and function without pulling you in two different directions. And trading successfully, the mindset of trading successfully, is not about being pulled in two different directions. It's taking one direction and running with it. It's saying no matter what, that I will continue with my discipline. I will continue with my plan. I will move forward. I will do the things I need to do. It reminds me of when I was watching, yesterday I was watching the flu game with Michael Jordan. The guy had a flu. He had like 102 temperature. He was throwing up before the game. He didn't sleep the entire night, but yet he played even though he felt exhausted, even though his body felt like absolute crap, even though he felt like he wanted to throw up, like he could barely stand. He stayed out there on the floor. He played his heart out. He did everything he could. Why? Because his mindset was only going in one direction. Will always be remembered as one of the greatest, if not greatest. Now, I'm not saying you have to have that same level of mentality as Michael Jordan, but you need to have a mindset that just moves in one direction. When you move into a tunnel, when you eventually get into that tunnel in your learning process, there is no doors and there is no windows to turn left or right. There is either you turn back or you go forward. Turning left or right takes you off the process, takes you off the track. You are no longer in the game. It's either you go back or you go forward. That's all there is. And if you don't have that mindset, that end of that tunnel, that corridor, will always be too far away from you. It will always be too much work. And so these are two things that will always interfere in your mindset with your trading mindset and will constantly be inhibiting you from trading successfully. And so with that being the case, hopefully that makes sense. Does that make sense to you guys? Does that resonate with any of you? No, complete garbage? Do people understand what I was saying? So a couple questions here, and then I want to get into the Aussie dollar. I want to try and unpack something pretty interesting. Troy Desert says, if you take shortcuts, you'll be cut short. That's a great, I've never heard it that way. That's a great way to say it. Paying for something means not only that you are serious in your intent, it also means that you will feel you burnt your investment if you do not put in the time and effort to make it work. Dang, that's really well said, Dry Desert. That's very well said. Kudos for stating it like that. James says, Chris, by the introduction alone, it sounds very interesting. How many times have we all downloaded free stuff, whether it be music, movies, books, PDFs, etc.? First answer to that question is, I've only done it once in the last 12 years, and I felt horrible the one time I did it. I felt absolutely horrible. I used to do that a lot. I used to download movies and music and all that stuff until somebody introduced me to the mindset of abundance. And this was an incredibly wealthy person. And I did a large webinar in this on FX Street called The Laws of Abundance. And when that person had given me a transmission on the nature of abundance, I vowed to change forever on that. And only once have I violated it between that point and then, and that was about 10 years ago. And I felt absolutely horrible for doing it, because I understood that everything that I had been working towards in my whole life with trading. I just created an energy that had undermined that. So that's my answer to that question. Now, your follow count is, we live in an electronic age. It's surprising what people put out there and what Google search will reveal. Someone call it being resourceful. Okay, so first off, just because we live in an electronic age doesn't mean that we should just go ahead and steal things and take things that are not given to us. Take that mentality to the nth degree. It's just okay to take what's not given to us. That would be chaos. People wouldn't buy things and keep them in their house. Every house would be like a fortress, because people are constantly worried that the next person will just take whatever it is. The mindset of abundance doesn't do anything to destroy abundance. And taking things that are not given to you destroys the energy of abundance. If you have an abundant mindset, you appreciate what you have, and you value what you have, and you understand the inherent value of having those things. And when you take something that's not given to you, you realize that you're undercutting that energy, that you're destroying that energy, because you're taking something that is highly valuable to somebody else. And you wouldn't want to do that, because you would hate it if somebody did it to you. It doesn't matter what is out there or what is not out there. That's not being resourceful. That's using it as an excuse. Nobody's forcing you to take something that's not yours. You're choosing to do that. But again, when you do that, you do two things. You undercut your mindset to think and be abundantly and to value things, and you're also communicating to yourself, I am taking the shortcut out. I'm not willing to do the work. There is nobody who's become a professional trader without doing the hard work. There is nobody that's become a professional pianist or golfer or basketball player or whatever without doing the work. Some people have done it more skillfully. Maybe they had more unique resources. But you take anybody who is considered at the pinnacle of their profession, and they will all tell you they worked their ass off to get there. And so, hopefully that addresses your comments there. Okay, last few questions, and then I want to jump into this here. Rob Smith said, I put thousands of hours into understanding price action, but still find it hard to take the right trades, even though I know exactly what to do. My subconscious seems to stop me a lot of the time. I've paid $10K for education, but feel that hasn't addressed what I need. That is making me resist spending more, as the answer lies within me. The answer does lie within you. More than likely, at this point, you have more than enough training, but maybe at this point, it's no longer a question of learning something new per se. I would be willing to bet, and I think you've kind of even stumbled upon it yourself. You said my subconscious seems to stop me a lot of the time. It probably means that you just have some subconscious or unconscious programs that are inhibiting the natural intelligence of the things that you've learned from coming forth. I would be willing to bet you have enough knowledge and information to trade successfully, but that there's some subconscious or unconscious programs that are kind of inhibiting that, or causing you to go off the tracks a little bit. And so with that being said, in some sense, I think your apprehension for paying more for education is understandable. I think if anything, you would probably want to spend your money and time removing subconscious or unconscious limiting beliefs. You can do that yourself, and there's many ways to do that, or you can do that with people who specialize in that. If you have more questions about that, email me directly, and I'd be happy to talk with you about that. Why? Because I spent the last now 11 plus years, 12 years, doing exactly that. Removing subconscious and unconscious programs or limiting beliefs that undermine my natural intelligence, skills, and gifts from coming forth. And so I'd be happy to talk with you further. Okay, last few. Al says, I would say that there are a lot of cowboys out there who sell rubbish trading systems, and if you've been burnt a few too many times, you will get to a point where you not want to spend any more money. It's a position I've been in before. It takes a leap of faith to try at least one system two, which is a hard step to take if you have come across poor coaching to date. That's an understandable point. I've spent money on the past that hasn't worked before. So the problem is the logic. You're twisting the logic. You're saying you're basically equating spending money to not working out. It wasn't the spending money part that didn't work out. It was not doing the proper due diligence on the coaches and the tutors and the systems and everything like that didn't work out. But you can't translate the result and twist the logic of that being, hey, well then the solution is, or the problem has been the money I've spent, so I should try the opposite and not spend money on it. It's a twisting of the logic by looking at the end result. The problem wasn't the money or the time or the effort. It was just you either didn't do enough due diligence or you got a bad luck of the draw. But that doesn't mean that every one of them out there is bad. So, and you can't translate it universally. Do you think you're the only person to get burnt or find something that didn't work? No. Do you think you're the only person that's done a bad business decision? No. I made one in 2010, 2011. It cost me roughly $50,000. $50,000. That's an expensive mistake that I made. About $46,000 because I went into business with somebody who I didn't do enough research ahead of time, which would have said, this is probably something that would not be a good decision for you. I didn't research it far enough because if I did, I would have found things later on that would have communicated to me, hey, this is not the direction you want to go. It was a very expensive business decision, and I learned from that. Am I going to sit there and translate that to being, well, I'll never go in business with somebody again? Absolutely not. I don't make anybody responsible for that but me. Even though that person totally screwed me over and did not complete their end of the bargain, I blame myself and nobody else. So hopefully answers your question. Okay, so let's see. Mark mine. Problem is that so many of these coaches have a dodgy newsletter, and there's a little out there in Google, and most articles are linked to the publishing houses, blah, blah, blah. Yeah, again, if you make a bad business decision, there's nobody to blame but yourself. Even though that person totally did not do what they were going to say they were going to do, and I did everything I said I was going to do, I did, and I put all the money in I said I was going to do, it didn't work out, I blame myself. I blame nobody else but myself. All right, so I think we've covered a lot of ground there. I think this maybe makes sense to some people. Maybe it resonates with some of you. Maybe it didn't. If it didn't, it didn't. If it did, it did. I hope it made some impact on you. With that being said, I want to get into the Australian dollar here. I took a short. The chart we're looking at right now is actually a while ago, a little bit ago, but I kind of want to just run through the whole scenario, the whole picture, and then I want to show you what I was kind of using as my initial trigger, but not my entry trigger, just my more tip-off that the market was going to turn, and then how I used that as a possible way to anticipate what the market was going to do, and then from there, how I used it, entry, exit, stop limit, the whole thing. So everybody remembers, or at least probably, that the Aussie dollar, like many of the dollar pairs and majors, were in a downtrend. And you'll notice that there is a subtle transition in the nature of the trend from here to here. What's interesting is that when the market bottoms, it creates this very interesting two-way candle. It's a two-way candle, and it has two things. It's a two-way candle, and it's a large candle, and both of them communicate something very interesting to me. With the downtrend being relatively stable, the only way that can happen from an order flow perspective is that the sellers are relatively in control. There are presence of buyers in here, but the sellers continue to make new ground to the downside, suggesting that they have more dominant control of the order flow. Well, what's interesting is that all of a sudden we run into a candle. If we run into a candle here that is quite large, exceptionally large. Look at this candle. This one candle is 150 pips wide, which is exceptionally large for one 4-hour candle on Aussie dollar. Now, the only way you can create a candle that large, I mean, from top to bottom, this candle is larger than any other candle in this entire series here. Out of 100 plus candle, it's the largest from top to bottom. Well, here's the interesting thing about it. Let's think about this. What produces a large candle? A lot of order flow and a lot of participation. But this is not just buyers and sellers. This is two-way order flow. We know it's two-way order flow because there's a decent-sized wick on the top side and there's a decent-sized wick on the bottom side. So there's a rejection of value down here and there's a rejection of value up here, but there's a strong body in the middle. So this large candle is quite telling in and of itself. We've had a very large downtrend happening for a long period of time, since way above 104. And then all of a sudden we have one candle, which is probably the largest from, let me delete that for a second here, probably the largest candle from May all the way to June. The largest candle in a month. So it tells you that there's an immense amount of participation here. Well, so we have immense amount of participation. We have two-way interest. But the other last thing about it is that the buyers take control of the candle. Now keep in mind what that communicates. We've had an immense amount of selling pressure in here for a long period of time. The trend starts to increase. It starts to change in the general structure, which you can see from here to here. So there's a change in the structure, which is communicating a change in the order flow and the nature of the trend. And then we produce a candle that is the largest candle. It represents two-way order flow, and it also suggests that the buyers have wrestled control of the candle. The market from that point on turns and now starts an uptrend. Now, if you remember my underlying theory behind price action, what is my underlying theory behind price action? Point number one is that I don't look at price action just in terms of patterns. I look at price action as a reflection of order flow. And my job as a price action trader is to interpret that price action, or to interpret the order flow through the lens of the price action. So that's the base of how I look at price action. But from there, what is the base model that I use to interpret who's the dominant party in the market? Those of you that have been with me for a while, I've been teaching this webinar series for a long time now. Who knows? Any guesses? Yes. Very well said. They kind of have an advantage to Kulpi and Gabrielle. They're kind of cheating because they're in my course. But good students that they did that, so I appreciate it. Impulsive versus corrective. I'm looking for impulsive versus corrective moves to communicate to me who's in control, who's the dominant party, and when that control is shifting. So I know when the market's turning. Under the base model of impulsive versus corrective moves, what's one of the few indicators to me that the market is reversing? I'm looking for a counter trend impulsive move. So the impulsive series will continue. Impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive, corrective, getting more impulsive, but impulsive, and then counter trend impulsive move. So there's an indication now that the trend has turned, the market has changed. Well, now I know that the market's changed in reverse, and I want to start looking for longs. But remember this candle down here. Now, all of you remember last week how I was talking about this particular trade in the Aussie US dollar. how I was looking at this here, how I recognized it was a key level, and that the reactions were getting softer and softer each time, which meant that the sellers are getting squeezed out. Do y'all remember that from last week? Yes, no? Yes, no? Anybody remember it? Okay, good. Fantastic. So the market continues and breaks out, and then ironically, we see kind of a transition in the nature of the price action of the trend. The price action gets pretty smooth. What do we see at the top of this here? Another two-way candle. Another two-way candle. This time the bears have taken control, and it just so happens to be, from top to bottom, one of the largest candles in this trend. It's about 90 pips. Actually, sorry, it's about 90 pips from top to bottom. We have to go way back to about here before we can find a candle that is that big. It's almost the exact same kind of cue that the market may be turning. Now, I don't use that as a trigger by itself that the market is turning. What am I looking for? I'm looking for a counter-trend impulsive move. Now, keep in mind that if you remember from last week, the main areas that I was watching as key levels were here, this triple rejection off of it, with weaker here and weaker pushbacks, telling me the sellers are getting squeezed. So I'm looking for a breakout retest trade, and that's what I took to the upside. Now you can see this same pattern on a more micro level here. Do you see it here? We hit a level, we reject off of it, we hit it again, weaker rejection. Bulls are continuing to squeeze the bears out. The doji here, right here, represents the last presence of the sellers that, for whatever reason, were deciding to stay in the market. Once they get squeezed out, the market takes off. But this is just a micro version of this pattern. So what does that mean? When the market does break out of this level here, this becomes a key level, a breakout retest level, right? Yes, no? Everybody remember this? Hopefully. Yes, no? Following along? Okay, fantastic. Now, if you all remember, breakout levels are always crucial levels. These are things that breakout retest levels are levels that I always pay attention to. And they're levels I pay attention to because both sides of the market have respected that particular level. Buyers and sellers have put a lot of money on their side of the fence saying, this is a key level for us. The buyer said this is a key level for us to buy, and the seller said this is a key level for us to sell. Now, we had a long uptrend in place, very long uptrend from 96 to 102, 600 pips, and so we have a long uptrend in place. I guess I want to show you something a little bit later. And then we have kind of a similar trigger to what we had down here. So I'm watching to see if the market may be turning at this point. Well, let me zoom in then for a second. Look what happens. Market starts to drift back down, treats the 20 MA. If the buyers are still in control, and this is an area where there's definitely some buyers, if the buyers are still in control, they'll use this area as a launching pad to try and retake out these highs. Minimally touch these highs again. But what happens after this? Boom! They push off it a little bit, and then the market sells off incredibly aggressively. Now, let me ask you a question. If this level was treated as support, became a breakout retest level, and then the market starts to round over and then fails through that, do you think this might be a good level to place a short? Yes, no? Can anybody see how that might be a pretty cool level to short? I have a weakening signal here. I have a breakout pattern here that is a micro version. It's not a larger version. It's a smaller version. I have a key resistance level, which is now support. So if the market breaks this level, then maybe this would be a great place for me to get short, especially if the market is selling off very aggressively going into this level. Looking at this on a 1-hour time frame, let me zoom back. Take a look at the selling going into this level. So here's NFP, two-way price action. Market sells off very aggressively, consolidates, corrective, and then impulsive. Keep in mind, I'm using the same structure. Impulsive, corrective, impulsive. 2 hours of selling takes out 1, 2, 3, 4, 5, 6, 7, 8, 9 plus hours of sustained buying. Who's in control? Sellers have now taken control of the market, and they've now taken out a key level here. And they've done so very aggressively. So, we now know my location to get into the market. We've identified an area that would be a great area to get in because it represents a couple things. It represents prior resistance and support, and it also represents to the buyers a location where they're going to get in. So when the market breaks past this enough, then what am I looking at? I'm realizing that there are bulls who are now trapped short. Some people entered on this level here, and now they're in the negative or taken out. So I've identified an area that's a key area where the market has responded very efficiently and effectively and clearly in the past. So I'm looking to get in around this level, and I've identified a few things here. I've identified who's got the short-term control. I've identified a weakening in the trend, and I've identified a level that's been taken out. Now, we know where I want to get in. So I have identified the level. I just want to get in a little bit below that there, very simply. I could say, hey, there's some price action here. Fine. You get in a little bit lower, no big deal. Okay, so here's my general entry area. Now, the first thing we look at is what? Once we've identified the area that we want to get in, what's the first thing we look for? Risk. Very good. Some of you have been really paying attention. So first I need to identify my risk. Okay, great. I have a couple options. I can look to put my stop above the area where the market started selling very aggressively. I can use that as one option because if they started selling aggressively there, that's cueing me to the location that the sellers entered the market with a lot of money and a lot of, interest. Okay, we like this level here. We're going to sell it. Bam, we're in. This is where we're getting in, and this is where we're going to push it hard. And we know they were pushing it hard from the beginning because the candle is a pretty strong candle, closed on the lows, but the next candle is even bigger. Part of the reason why it's getting bigger is not because they've taken out stops, because this candle really hasn't taken out many stops yet. The stops are probably here or even below. We know it's getting bigger because the initiators who sold it very aggressively here detected weakness. They sold it. Other institutionals are catching on to this saying, okay, this thing's reversing. We know it. We've missed the initial price right up here, so we're going to get in here. They're chasing it because it's basically a race for who can get the next best price. The initiators who put the most amount of risk on the line get the best price, but then right after that, other people recognize it and they start getting in really quickly to get the next best price. So then this accelerates the downside. More players are coming in, and we see this in the candles are getting bigger and bigger and bigger. Now, okay, with that being said, we now know that there's some strong selling here. So I could place my stop above this here. That's not bad. It's 60 pips of risk. I'm open to that. The other thing is, what were other key areas where stops might be placed? And this is one area that comes up for me. Resistance, support, kind of support, resistance here. So I said, hey, here's my level. That's where I think the market should hold. And so with that being said, that's one idea. Another idea is this above this candle right here. Why above this candle right over here? Any guesses? Any guesses whatsoever? I'll zoom in a little bit here, see if I can make it easier for you. It's the breakout bar, yeah. Okay, so let's see here. There was a pause and a big fall from it, roll reversal level. Okay, now it's sellers right from the open. The thing opens, there is no wick to the top side. Zero wick to the top side. And they're selling very aggressively in front of a key support level here. So it's kind of like no worries, very little lack of confidence here. This is aggressive selling right from the back. Literally, as soon as the candle opens, there is selling pressure already present in the market. So now, and on top of it, it's a pretty good intraday support level. It was the Euro session lows, rejection low over here. This is not a bad level. So when I look at the grand scheme of things, this is the best level for me to do it. I'm going to get some protection from anybody who has their stops right around here. There's strong selling from here from the open. So very simple. I put my stop a little bit above this here, maybe right about here, and there we go. I get pretty good protection, and look what happens. Now, we've identified entry, and we've identified my risk. What's the last thing we look for then? Yeah, reward. We've identified the maximum risk we're willing to take. And remember, the stop loss is really the level you're saying, if my idea is correct, the market should not go there. If my idea is correct, the market should not go there. That's what your stop loss is saying. So, okay, that's what I'm saying right there. Now, we've quantified the risk. It's about 40 pips. All right, now, can anybody guess a downside target that I might be thinking of? Any guesses? Let me zoom out just a second. Oops, I don't want to show you that much. But can anybody, let me switch to a 4-hour real briefly. All right. Okay, so we got a couple guesses here. 150, that would be right about here. Not bad. That's a pretty good level. That's a very good level for a downside target. Doesn't make sense from an R to R perspective. 40 pips risk, 70 pip target. Makes sense. R to R is not bad. It's not 1-to-1, but it's not bad. It's over 1-to-1, so it's not bad. Kesta says parity. Reyes by 2 says 122. 122. Let's take a look at that. So I think you're seeing right about this right here. That's not bad. Not my favorite because there isn't too much of a reaction down there, but it's not bad. Colby says parity for the second, 100, 120 or lower. Montes says 109. Montes, you are the winner. If this was a key area before that created the strongest reaction, I will be concerned about a possible stopping over here. But really, this is where I think the market should go to because this was a very strong level. Therefore, the market should gravitate towards it. This is kind of a minor swing point. This is a major resistance level. So it's possible it could stop here. But this is really where my target is. Now, we have to account for spread, give it a few pips a little bit extra, and look what happens. Bam. It actually doesn't even pause at this level. Why? Because it's a minor swing low. It's not a major level. And look what happens. Consolidates. It actually treats this as resistance, and then boom, hits my target. Can everybody see how that was a natural gravity point for the market to go to? And why this is not quite as strong a gravity point? The market only had one reaction to this. Here it had 3. Plus it's right near a round number. Can everybody see the gravity that that level would have? Yes, no? Okay, great, fantastic. So let's take a look at some questions. Scrolling up. Trying Trader says, if mentors give a money-back guarantee, it would go a long way. I'm going to disagree with that theory. I'm going to disagree with that theory because, what I give is intellectual property. This is not a shirt or a car that I can take back. Once I give that intellectual property, there's nothing stopping that person from repropagating that, from using it for their own personal means. And there's also no guarantee that you're going to use the system and method the way it's supposed to be used. I could train 100 traders on the same method, and I can get anywhere from 10 to 20 people who are using that system completely differently. Should I be responsible for them using it differently? I'm not there helping them push the buttons. I'm not the one who's, deciding how they employ that strategy or what pairs they use it on. I can't force a trader to trade a certain way unless they work for me. If they work for me, I can force them to trade a certain way. So why should I offer a money-back guarantee when there's no way you can guarantee me that you're going to use it exactly the way it's supposed to be used? There's no way. So I can't agree with that method. And not every trader will use it properly. Not every trader will understand it properly. So I disagree with that, trying trader. Todd says, do you wait for new candle to open below the EMA? Not so much. And the reason, yes, that's a good indication for me, but I had a lot of key levels that I was more concerned with. If the market had an immense amount of reactions to the 20 EMA, then I would say, okay, the market is more reacting to the 20 EMA than a particular trigger or a particular level. But since that wasn't the case and I had some clear levels, I would not need that to be present for me to say I'm going to take this level. If it's there, it will be an optimizer for my signal. It will help the strength of the signal. But it will not be a requirement. So hopefully answers your question. Alex M says, isn't price a little bit too extended from the EMA? I'm not sure which chart you're talking on. The 4-hour, 1 hour, I'm not sure about that. So you have to let me know. Harley says, would you ever fib this? Don't need to. Don't need to fib it. I don't need to because I can see where the market's responded to that. Remember, when do fib levels become more powerful? When they line up with prior support and resistance. So that tells you that fib levels by themselves are never enough. They're useful, not necessary. But I don't need fib levels to fib this one here. For me, I could tell where the gravity point was. When you learn how to read price action, you don't need fib levels to find the gravity points of where market will or will not respond to. Gabriel says, is this being recorded? Yes, it's being recorded. Santos says, can you show the 1 hour chart, please? Sure. I think I was showing the 1 hour chart at several points along the way. But yeah, here's the 1 hour chart leading up to it. So hopefully that gives you what you're looking for. A-Train says, would it not make sense to wait for a pullback to the 1 to 125 area where expected support was broken? That's definitely an opportunity. That is definitely an opportunity, or that's definitely one possibility. And I would be open to that, but the selling was so aggressive and so violent. If I trade 10 breakouts, 7 plus would be breakout pullbacks. So 3 or maybe 2 out of 10, I will do, just the pure breakout. So hopefully that gives you a good gauge though, which is that when trading breakouts, I generally prefer more often than not breakout pullbacks. You could have at the same time gone to even a smaller time frame, maybe a 15-minute, and then looked for and see, I know my levels. So here's the breakout, and guess what? You see it. Breakout, pullback, bam. So there is a way to do both and. So hopefully that answers your question. Harry Q101 says, wouldn't you treat the round number as a barrier as it's the Aussie? Yes and no. Sometimes parity will mean something, sometimes it won't. I've seen times where the market was really respecting that round number or parity, and I've seen times where it just completely disrespected it. Went 15 pips past it, 20 pips on the other side, 30 pips on the other side. No, there was just no stopping at the parity level itself. Sometimes it will, sometimes it won't. In this case, it was a little more obvious because the market had retreated as resistance before, so therefore I should expect the market to respond to it in the future. So hopefully I answered your question. This daily chart for it was the 4 hour and then the 1 hour, and then I just zoomed into the 15. Trader says, Chris, how should we feel about coming to these free FX Street webinars? I think you're referencing in relationship to the topic that we're talking about earlier. There's a difference between this and the other one. First of all, Rob Smith said it pretty well. Free isn't the same as stolen. Second, I'm deliberately choosing to offering my time and my experience. I'm inviting you to come to these webinars and say, hey, come to these webinars. I will commit my time to teach. If you want to learn, you are welcome to come. That is completely different than taking something that is not given to you. I'm not offering something here that I'm not willing to let go of. I'm deliberately communicating. I am offering my time and my expertise and my experience. That is completely different than, walking into my house and stealing something. So I see that as please excuse me for saying that, but I see that as kind of a ridiculous statement. I'm choosing and I'm offering my time willingly. That's very different than, stealing something. So hopefully that makes sense. GY says, do you always trade on the 1 hour chart? No, I trade the general time frames that I like to work with are 1 hour, 4 hours, and dailies. Yeah, that's generally the time frames I like to work with. So, but really this trade was a combination of more the 4 hour and the 1 hour. It was really, I used the 4 hour to kind of spot the overall change, the overall turning points, to sense the weakness, to look for the market to change structure, and then I used the 1 hour to refine my entry. If I could have done it cleanly on the 4 hour, I would have, but in this case, I realized, hey, there might be some information on the 1 hour chart that will be useful here. So hopefully answers your question. Traded says, Chris, where is the best training to learn to distinguish between impulsive versus corrective price action? Well, I would say I have a ton of free webinars. That is one place. FX Street has recorded a lot of these webinars. So that would be one way to understand the nature of impulsive versus corrective price action. If you want to learn to read it on a more subtle level, want to learn to find some of the more cues and clues and variables and ingredients that will clue you in on how to read it, come to my website. I have articles on it. I have videos on it. And then if you want to take it to the next level, I have a course on it. The whole model of trading price action is based on that. And I teach you systems and methods and ideas and tactics and strategies and everything you could possibly want to know about impulsive versus corrective price action. I teach, and I constantly upgrade the material and add new material. So I know of nobody that talks about it as thoroughly as I do. Everybody has their own style and method, and my style and method is understanding impulsive versus corrective price action and how to identify the order flow behind that and trade that. How to find the key levels, how to find the subtle characteristics that will clue you into when the market's turning, when it's continuing, when you want to trade with trend, when you want to reverse, how to reverse, how to understand the difference between some trends and other trends. So that's just a fraction of what we teach. So hopefully answers your question. Kudaku says, what books can you recommend for learning how to use fibs? There is one book that I'd recommend. Let me think of the name here for a second. I'm going to look it up real briefly. Give me 2 seconds. I don't think there's another speaker after me. I hope not. Let me think here. There's looking for the person. There it is. Okay. It's called Fibonacci Analysis by Constance Brown. The one challenge about this, and I'm giving you a huge warning ahead of time, is that section 1 will be relatively easy to understand, and a lot of it will seem kind of like material that's already out there. Section 2 is where things start to get tough, and then the last section, unless you have a high degree of mathematical skill and understanding, you will have a lot of difficulty digesting the material. It is very technical at that point. It talks about Fibonacci's in a way that I've almost never seen anybody talk about Fibonacci's. It's highly advanced, and it's highly mathematical. So you're going to need some math skills to really understand it. So that would be my recommendation on that. Augusta said, "Hi, Chris. I just wonderful if you had a useful perspective for dealing with that missed out feeling that can arise in those situations where a position you have reaches your target but runs away further." This is a really good question. Okay, so, and this is something that everybody, I mean, almost everybody comes up against, has come up against, or will come up against. So, to repeat, the perspective for dealing with that missing out feeling that can arise where a position you have reaches your target but runs further. There's a couple ways to deal with that. You could adopt a price action method that allows you to hold on a trade if the ingredients are still there for staying in the move. And so you could adopt a method that teaches you to do that. The thing is, that takes time, that takes a lot of experience, and that takes a lot of skill. And so that is a path you can embark upon that. So this way you just say, hey, look, I'm going to stay in a move if I have all the ingredients which are communicating that this move will continue. But you're going to have to learn to read that, and that will take an immense amount of time and skill to do that. But here's the real question. The underlying feeling, and I want to address this. What's the underlying feeling behind that? It's a feeling of missing out. Now let's break that down a little bit further. What is that feeling of missing out really a result of? It's fear. It's fear, but even more specifically, it's an anticipation of what has not yet happened yet. The Buddha once said, fear is the anticipation of what has not yet happened. And that's the real underlying, I guess you can say, material behind that feeling. You will never know what's going to happen next. I have no idea what is going to be on the right side of my chart. I can learn through the tools of price action and my other tools and methods to learn to read the market as best as I can with whatever information I can get and make a informed decision, an idea, an anticipation about what the market is going to do. But you will never know what the market will do. And so to be upset or frustrated or worried about something that you cannot control is like being upset about the weather. Now, if my bet is, Augusta, that if your trading was really stable, really consistent, and consistently profitable, you wouldn't be worrying about those moves that go a little bit further than you anticipated and you didn't catch. You're probably more worried about them because catching them would mean a big difference between probably being profitable or not profitable. They might make up for some mistakes you had or some losses you have. And if you can learn to trade profitably and consistently, you're not going to be thinking about all the ones that you miss out because you're going to miss out on thousands. You can't be here 24/7. You can't always be watching the market. It's very possible that the market could do things while you're asleep and no longer able to monitor the market. that would clue you into this is going to reverse or this is going to continue. What do you do about that? You can't. There's no way you can fully understand what the market will be doing at all times because you can't be there all the time. And to be worried about or feeling like you're missing out on something that you can't control, it's like me being upset that the weather isn't doing what I want it to do. Either I go to a different climate or I just understand that tomorrow will bring whatever it brings. And the best thing I can do is to trade the market that is given to me and that's in front of me. I can learn to read it as best I can. I can learn to trade it as best I can and make as much out of it as I can. And when you start to hit consistently, month after month, year after year, you won't be thinking about those things anymore that you missed because you're doing exceptionally well, and more particularly because you're taking advantage of all the opportunities that come when you're there. If you take advantage of all the opportunities that come when you're in front of the market, if you give it 110% all the time, as best as you can, no matter what shape or condition you're in, if you do your preparation, you do your homework, you study, you do your journal, you use your proper risk management, everything, you prepare for your trading day mentally, physically, emotionally, the whole thing, you study even when the markets are not open, if you give it 110% and you get positive results out of it, that feeling will go away. I know this from personal experience. I know this as a fact. From my personal experience, that will go away. There's nothing you can do about things that are outside of your control. And so that's my thoughts on it. That's my experience on it. That's what I have to share after doing this for over 12 years now. Hopefully that gives you something to work with, and hopefully that gives you something useful. Okay, a few more questions, and then I want to wrap this up, plus I have to go to the new. A-Train says, okay, so you can scale down the time frame to look for a shorter-term pullback. You can. Absolutely. There's nothing wrong with that at all. Nothing wrong with it at all. Remember, time frames are just a lens into the market. You're looking at the same price action with a different lens. Larger time frames give you bigger picture, and they will often show you things that you will not see on smaller time frames, particularly key levels, overall trend, overall structure. It's big picture. Smaller time frames give you more detail, but oftentimes you will not be able to see the key driving force in the market if you get down to a certain level of time frame. You will not see the key trend. You will not see key levels that are coming up way ahead of time so that you know what to be looking for. So they're just different lenses into the same price action. Trader says, thanks, Chris. I missed the first 10-15 minutes, so thought you were stating that anything free is wrong. Mindset, didn't know you had given examples of stealing. Julio. Well, I apologize if I jumped on you for that, and so hopefully it's a little more clear now, and hopefully, it kind of makes more sense. GUI says, so 4 hours give you the sense of trade direction and 1 hour to identify the entry point? Yes, but it doesn't always have to be like that. Sometimes I can trade and do my entry completely off the 4 hour. Sometimes I can do it off the daily. But I like to have those three time frames as my general perspective in terms of looking at the market. Sometimes I'll go to the 1 hour, sometimes I don't need to. So, sometimes I'm using the 4 hour and I can do everything I need to do off the 4 hour. Sometimes I'm using the 4 hour and it might be helpful for me to see the 1 hour. It just depends on any individual situation. But you can definitely use it that way. GUI says, can you send us a link to your website? Sure, I'd be happy to. Okay. GUI said, let's see, all of us leave money on the table. You're going to leave money on the table. You're always going to leave money on the table. I can't tell you how many trades I've left money on the table. Eventually, you don't think about it. You just put 110% into the ones you have in front of me. Al says, that happened to me too on gold today. Breakout to the downside. I knew that would fly, but I stopped at half of what target should have been. Was way too conservative. You call it fear of how gold can cause 100-pip moves in the wrong way at the blink of an eye. True. It's hard for me to comment on that fully because I don't understand your full trade. Augusta said, so perhaps learn to become grateful for what you do catch instead of whining about what you miss. That's another translation of it, and that's a much more that's one way to translate what I said, and so I would agree with that. Accept it as part of the process. And it says, what's the max number of trades do you have per day in general? For me right now, it's a lot less because I got a lot of things going on. I'm writing the book. Second Skies is growing at a rate that I had never anticipated. The fund is becoming more and more complex in terms of managing it, in the sense of, there's a lot of legal things, there's regulations, there's taxes, there's, registration fees. Even though I pay for somebody to manage a lot of the aspects of the fund alone, I still have to make a lot of decisions. So, I'm trading a lot less today. So for me, max number of trades right nowadays, 1 to 3, because I'm not really trading full time. If I'm trading full time, like if I'm literally, I had no website, I had no fund, it was just me and my account on an island, and that's it. It could be anywhere from 3 to 12 trades a day. I'm not really so concerned about the max number of trades per day. I'm really concerned about max risk per day. And, what is my max risk and exposure? That's more of what I'm concerned with than anything else. So it's max risk and exposure. Dry Desert says, what is counterintuitive about trading is that we naturally use to take the result of our last action, the last trade, as feedback. This is misleading because of the random factors. My take on this is that I have to basically ignore the last trades and only. That's one thing that paralyzes traders, is that most traders define themselves by their last trade, or they let the experience of the last trade be so dominant in their mind. And so, it would be like a golfer being upset about the last shot, or a basketball player being upset about the last basket, the last shot they took. You can't, you take your shots, you do everything you can to make it the best one you can, and then you move on to the next one. And you're going to, if you're constantly thinking about the last trade, you'll be paralyzed. Your trading will always be dependent upon the last trade on something that you can't control anymore. The only thing you control is what you can do right now. So with that being said, so many beginning traders get caught up on the last shot because they don't have many trades of experience. But when you have thousands of trades, you're not thinking about the last trade. And, as trading as a whole, you want to get away from looking at individual trades and more thinking about the process. Stop thinking about individual trades and results and focus on process. Far more important than any individual last trade. It would be like an archer who's constantly thinking about the last arrow. How can you be fully present with the trade in front of you if you're constantly thinking about the last arrow? A professional archer will shoot anywhere from 250 to 1,000 arrows a day. What would be the point in thinking about any one individual arrow? You have to, if you're focused on and thinking about and paralyzed by what's happened in the past, you'll never be able to fully dedicate your resources to the present. So that's my thought on that. Trader says, Chris, on Aussie breakout since that breakout level was broken to the downside, failing below 99.80 and now back above. Do you still consider it a level to watch for and are still worth getting long from back since that level? Not so much anymore because the market has kind of had an interesting, I'm watching it, but, it could use this level to be as a support to form a higher low. Or this is a swing low, lower low, higher low. So it could be forming a bottoming structure. I'm watching it, but I'm not going to say it is, okay, I want to get long here. I'm not totally convinced that this downtrend is over. And I'm going to want to see more information that this downtrend is over yet. I don't have that yet. Rarely ever do downtrends end on swing low, lower low. So hopefully answers your question. Popped in on phone. Jim says, which all means to grateful for the abundance that comes into your life. It's very well said. Rob Smith says, no, I want to manage other people's money. It's not easy. It's definitely it's a stress. It's a different kind of stress. You know, and it just depends on how you relate to it. You know, it can be stressful. It can be not stressful. You know, it's more stressful if you know the people. That's why I really, you know, try not to manage anybody, you know, that's really close to me or anything like that. Not because I'm worried about the results, but I want to, when I'm trading for the fund, I just want to be focused on the trading. I don't want to be focused on anything else. And so that's what I want. I don't want to be focused on anything. And, you know, I try and choose investors who are very long-term minded and they're not micromanaging things. You know, I have a rule with my investors. We discuss the parameters for your account ahead of time and we agree upon those parameters. As long as I'm trading within those parameters, I don't hear from you other than administrative things. And my traders will not hear from you other than administrative things. Because our job is to focus on trading and maximizing profitability through using our edge in the market and finding opportunities within our parameters. That's our job as traders. So if we're not stepping outside of those bounds, we don't hear from you. Okay, last few and then that's it. Pablo says, why you named your company Second Skies? Gosh, that's a long story. Maybe I can get into it at another time, maybe the next webinar, but I really have to go to the bathroom. I have to answer this last quick question, and that's it. Chris, how do you keep your brain in neutral when you're in a trade? Sometimes it's hard to see the other side. Then after you reevaluate the situation, then you say, well, I could have been short for the entire time, for example. Sure, you can always make a different decision in hindsight, but the best way, this is one of the most important things you can do when you're trading. When to keep your mind in neutral, first of all, it takes training, it takes practice, but if you can focus on one thing, focus on the trade in the market, not on your profit and loss. That would be the best thing that you can do to keep your brain in neutral. But I spend 3 hours a day before I even come to my trade desk, before I even make a trade. I do 2 hours of yoga and meditation. I do an hour of mind training beyond that. We're talking binaural beats and isochronic tones to train my mind to get into an alpha or delta or, you know, and to get into these more relaxed states. So you can train your brain to being in neutral as much as possible. I spend 3 hours doing that before I even push a button to hit buy or sell. So you can train it, but if you're not going to do that time to train, focus on the market, not on profit and loss. All right, fantastic. So with that being said, yeah, fantastic. All right, great. So this is that's pretty much it. I want to thank you all very much for coming. It's fantastic having you all here, talking with you all here. Great questions as a whole. I will definitely miss you guys over this time period that I'm taking a break. And so if you have questions, you can find me at secondskiesforex.com. You can join our community of traders who trade price action every day and talk about it every day, learn more techniques on this, take it to the next level. But thanks to FX Street for hosting this webinar. I'll be in touch with them as to when I'm doing this again. So maybe early August, maybe end of August. Until then, I bid you all adieu. I wish you guys good luck trading. I hope to hear from you either through FX Street or on my website. Until then, good luck trading, everyone.